All right. Good morning, financial professionals. I'm Phil Haug, Senior VP of Sales here at E4 Insurance Services, and I'm tripping over my words today because I think my tongue's frozen. I think that's the deal today. But anyway, I do want to welcome you to our weekly brew, building relationships every single week. And I do also want to bring light to we like to highlight our national days today. This week we have the Brews national days are National Tug of War Day, National Airboat Day. I don't know. I think that's more of a Florida thing, right? The Florida back in the swamps, and then U.S. Coast Guard Reserve's birthday. Helping us protect our borders and our coast. So that's pretty cool. Today we are continuing our business valuation lineup with Jason Jafferis, MBA and Regional Vice President for Prudential, on how to learn simple value-added steps to open up doors for business owners with planning and annual reviews to set up the opportunities to enhance your client's planning and also potentially uncover significant gaps in unforeseen tax exposure. What does that mean in English? What that means is we're going to talk about the services that Prudential offers to help with business valuation, but then also we're going to talk a little bit about they have a loan rescue program that a lot of times people buy. Jason and I were talking before the call today, and a lot of times you buy a permanent life insurance policy with cash to use it, right? And that's, when a policy is used and the cash is taken out of it, that's when you got to make sure that it's manicured and managed a little bit different. And sometimes when you start draining cash out of it, it can put the policy at risk, which can run into a little bit of a problem. But Prudential has a great solution, and they've actually kind of expanded some of the offerings and solutions around the loan rescue program. So he's going to talk about that as well. So as always, we encourage you to use the chat box. Ask any questions, raise your hand if you feel so brave and emboldened to jump in on the audio call. That would be awesome. And as always, all of our attendees are registered into a drawing for a CE voucher and a Starbucks gift card, and we will announce the winner at the end. So, Jason, thank you for joining us today. Also want to make note, I'll mention it at the end of the call too, but Jason will be also joining us and talking about some of the stuff at BBT Great Lakes, which is coming up at the end of April. So if you have some interesting things, or if you have an opportunity to uncover some cases between now and then, I'm sure he'd be happy to talk to you about that at that time. So, Jason, I'll pass the torch. What's going on?
Thank you, Phil, and thank you, everybody, for being on this call. I first just want to say thank you to E4 Insurance for the partnership that we have with you. The growth that we've had year over year has just been fantastic, and you guys truly have been a great partner with us here at Prudential, and I very, very much appreciate it. Always good to represent you as a firm and get opportunities like this where we can bring solutions and opportunities to the people that you work with.
Well, we appreciate the work you do for us and the solutions you guys offer. And when you say partnership, that's not a word that we like to use lightly. It's partnership's a term that is earned, and you yourself and Prudential have definitely earned the title of partner with us. So it's reciprocated on our appreciation. So thank you.
Excellent. Yes. And so, yeah, I'll start out by, the theme obviously is the business marketplace, and it's obviously a hot topic for this year. It's a great starting point for getting to know business owners, being an advocate for them as a client, and just finding solutions and things that help them both from a business perspective and personal perspective. And today we're going to talk about business valuation opportunities. And as Phil mentioned, we're going to get into some loan aspects of it as well. And I'll preface that when I get there with some statistical stuff. But from a business valuation perspective, what is it, right? A business valuation, there's two different types. There's a formal business valuation, which many businesses do go through on not every year, but maybe every 5 years, every 10 years. It's a good exercise to go through, but it is somewhat costly, right? It's $10,000 to $20,000 depending on who's performing that service. And then there's an informal valuation, and an informal valuation is what we provide, and this is a free service to you and to your advisors. All that we ask for is 2 years of the business tax returns. From that, we can actually calculate a very, very rough estimate it's not exact, but it's pretty darn close
Mm-hmm.
to what that business would be worth from an IRS perspective. And with those 2 years of tax returns, I'll show you here's kind of the output that we can put together. This is just a sample output report of what we can produce based on those 2 years of tax returns. We're going to look at all three methods that the IRS uses to value a business. They use the
Uh-huh.
capitalization method, the earnings method, and the asset method. And then we kind of just average the three of those together, and that's the value that you see at the bottom, right? So what does this do, right? What is this good for? Well, one, if
Yeah.
they've had a formal business valuation, let's say 5 years ago, and the business was worth 5.6 million. Wow, we've got a number that's significantly higher than that. That's a good thing. That means we're growing. First and foremost, that's a great story. But secondly, what does that mean to the business, right?
Right.
What does that mean from a planning perspective? What does that mean from a solutions perspective? What do we need to be doing as a business since we're growing, right? At Prudential, we also have an ebook that we have. This is just one little snippet, and I just wanted to highlight this.
Mm-hmm.
There's different phases within a business, right? If once we identify what they're worth, we also want to identify what stage of the business they're at. Are they still in startup mode? Are they in a significant growth mode? Are they a mature business? Has maybe their valuation has leveled off, but they're still seeing solid, consistent revenues year over year?
Right.
Or are they in a transition period? Is the 5 year plan to maybe sell the business or transition it to the next generation?
One of the things
Because
that, if I could jump in, one of the things that kind
sure,
of it was counter. I like this slide for a couple of things, but what jumped out at me too in reviewing it was like a lot of times it's somewhat counterintuitive, right? So like when you think about starting up a business, a lot of times you think that that's when you have the most risk. Brand new, we don't know what we're doing, or we're just getting established. Sometimes it's they got that entrepreneurial spirit, and there's a lot of risks that are associated with it. But when it comes to our business, when it comes to the things that we're doing, this shows like, well, there's really kind of just a couple things that we need to take care of. Where when you've got an established business, right, the feeling is, okay, we got things kind of settled out. We've got things, we've got a cash flow, we've got people. When in reality, the more established business presents more risks that we need to handle than a startup business. So it's kind of counterintuitive on the risk profile to making sure that that they have things covered. And one correction I want to make, he said the word free. I think the word is complimentary. Nothing's free.
yes, good correction on that. Yes, complimentary service. And you're right. You're exactly right. When you look at a startup business, it's really the entrepreneur. That's the risk, right? If something happens to that key owner, that's your major risk. That's your source of lending. That's your source of intellectual capital. As you grow and mature, you're starting to add key employees. You're starting to look at employee retention and deferred comp. Keeping people employed at your business, especially key people that have helped you build it along the way. There's more risk that's involved there. As it matures and as you get toward transition, there's even more risk. Is there a transition plan? It's I don't have the exact stat. It's somewhere near about 40 to 45% of businesses that if you ask a business owner, I'm going to retire in the next 5 years, what is your succession plan? 40 to 45% don't have one.
Right.
Well, I just thought, my kid would take it over. Well, does your kid know that?
Does your kid know? Yeah. And
You
does
know?
the kid have the funds to do that? And are the cash flows sufficient to provide the the buyout? There's so many. It's like one question opens up the Pandora's box of 500 behind it, right? And I go back to like the valuation. This is so important. Where if I'm a business owner, do I want to sell the business? When I sell it, do I want it to be worth the most it's ever been and growing, or do I want it to be worth less and shrinking? Well, any good business person knows, like, I want to sell it on the day that it's worth the most and growing, right? I'm going to get the more favorable buyout. So even, some of the transition questions that come up, those are important, but getting the precursory evaluation of what's the pulse of the business. It's not a bad idea every so often, even if you're a sole proprietor or running a small business, is your business growing? Because then that gives a very, very compelling story in the transition phase. or recruitment, right? If you're, I'm assuming that if you're an active and highly sought after employee, I'm assuming, Jason, you'd want to go work for a company that's actively growing, not shrinking, right? Yep.
Back to the valuation and kind of how you can use that, it's probably not recommended that you do it every year, but I would say every 2 years because you have two
Right.
new tax returns that have come in. Again, a complimentary service. Why not get a snapshot of how the IRS would somewhat view your business in terms of value? Because it does give you just some added information to your business to tell you where
Mm-hmm.
you are in the process. And along with that, again, you can look at these concerns on the left hand side, and as an advisor, these are great door openers. A business valuation opens the door to have all these conversations about employee retention, succession planning. What's your retirement plan?
Right.
Do you have an estate equalization issue? Do you have kids in the business and some out of the business? How do you plan to address that? When you do decide to kind of hang it up and move on. Um, so all of these topics, which are pertinent to what we do every day,
Mm-hmm.
can come simply from doing a business valuation and starting the conversation with an advisor, with a client. And that's just we all look for opportunities. We all want leads. We all want, a warm referral or a center of influence to provide, access to opportunities. And you have it in your book of business, and you can really open it up just simply by offering this complimentary business valuation and then starting these conversations.
I had an old mentor tell me once. He said you got $100,000 worth of business in your filing cabinets. If you guys remember what filing cabinets were, he said you got $100,000 worth of new business in your filing cabinets. You get to decide how much of it is yours this year.
That's actually a good way to look at it. I like that.
He was right.
I like that. I like that. Um, and then from this, typically, the question of do you have any life insurance in force?
Hmm.
Simple, easy question, right? And if they're a good client of yours, and you're unaware of it, they should bring it up. It's worth
Hmm.
doing a policy review again every 2 to 3 years, especially if it's a cash value policy or if it's a business related policy, if it's a buy sell. You know, making sure that the title is correct. Is the
Hmm.
beneficiary correct? Is the ownership correct? With the Connolly ruling, I won't spend a lot of time on that, but with the Connolly ruling, there might be some opportunities to change up the way your buy sell is even serviced or the way
Hmm.
it's structured, right? If it's a
Yep.
business owned policy, you need to be aware of that. What effects does Connolly possibly have on that buy sell in terms of funding? Is it better to move it to a cross purchase, maybe repurchase insurance in a different structure to help the business
Hmm.
um, from a tax perspective? And then oftentimes when we do these policy reviews, and this is kind of my transition into the loan rescue space,
Hmm.
we find out that there are loans on policies,
Hmm.
whether it's an old universal life policy, an old whole life policy. The business owner marketplace, surprisingly, is about 65% of the loans that we find on policies are
Yeah.
business owner related. They come from a business owner policy, not necessarily the business owning it, but it is a business owner that has that policy. And one of two things have happened, right? There's two ways you can get a loan on a policy. One, they stop paying premium and it's a
Yep.
whole life policy, and the policy goes into what's called APL, automatic premium loan.
Hmm.
And if you don't pay your premium every year, the company automatically loans you money to pay that premium so that the policy stays kind of on course.
Hmm.
And while that doesn't seem like much, that if that happens year over year over year over year, that loan balance can add up quickly.
Well, then you,
And it,
well, then you get into
yep.
the nuances of, we talked about this earlier, the policies in it. This is not a knock on anybody. This is just a statement of fact. When it comes to the structure of the accumulation phase of a permanent policy, there's a little nuances, but they're generally kind of the same, right? Um, but when you look at distribution, that's when, the reference I gave you earlier in the call is, so when it's accumulating, we're talking about a red Corvette and a white Corvette, right? They're still Corvettes, but when you start taking money out of it, they go from a Corvette to a Cobalt. And when you get into whole life, you've got situations where there's carriers that will just stop paying dividends on that contract as soon as you've triggered a loan. So, you can now you've got a double deflating balloon. You're drawing cash out of the contract, but then you're also not generating any cash on the money that you're not generating any dividends on the money you left in, right? So those are when you get into, those review phases are so important because it might be a great policy. It might require just a little bit of cash to stay in force. Might, a loan provision a loan rescue might be a good solution for it, which is what we're talking about today. But there are a lot of nuances when it comes to taking money out of a policy that will affect dramatically the performance of that contract.
The timing right now for talking about loan rescue is actually very pertinent because what we've seen, we've been in this marketplace for close to 15 years, and really we've been on the forefront of it. We've designed our products to be able to work in this space extremely well. What we tend to see is that 5 years after an economic, call it decline, is when we start to see the problems happen when money's taken out, right? So 5 years ago, or basically 2020, right? The economy did what it did based on what happened with COVID. And for some business owners and just for your normal everyday clients, some struggled to make ends meet. And where did they go to? They went to their policy. They took money out or they stopped paying their premium. And here we are in 2025, 5 years later. And now is when the statements start coming and there could be a notice of, guess what? You better pay more premium or this thing is going to lapse.
Right.
And so where we get into the process, and this is what we do with every policy that has a loan, and we really try to bring this story every single time because we're not promoting necessarily that you should replace it, but we want to promote you should be reviewing and managing these. So there's really three things you can do. You can do nothing and just let that policy grow. Maybe it's still in great health and there's nothing that's pertinent that needs to be done right now. We can make changes to the existing policy. We can decide, okay, I'm going to pay off the loan or I'm going to pay a certain percentage more each month to try to pay down that loan or at least manage the interest. Or, you know what, I'm really done paying this policy. I just want to kind of get rid of this problem and kind of let it rest. And that's maybe a 1035 situation where we can look at a more efficient product that has better loan provisions. And that's where we kind of get into it. And from a portfolio perspective, I guess one really favorable thing about Prudential is we're not a one-trick pony from a product perspective. We have fixed products, we have variable products, we have survivorship products, all that are in play and can handle these situations and put forth a competitive solution. It may not always be the best. The do nothing may be the best offer. We don't know.
Right.
It really takes a really in-depth review, which your friends at E4 in conjunction with us can do all that work for you behind the scenes. And just real quick, I'll give you kind of a case study. This is just the simple layup case study. We do a lot more complex than this, but I want to bring this up because I want to draw your attention to a couple things. So here's our case study. We got a death benefit of $1 million, gross cash value of 375. Okay, a pretty typical whole life policy or maybe even a UL policy. An $80,000 loan, not much. They're not paying premium anymore. They decided we're done, and their cost basis is $175,000. Okay, so all in all, the policy's probably in pretty good health, but that 80,000, this is a whole life contract, is going to get hit with 6% interest every year. Okay, so that's what?
That's about $5,000 a year.
$5,000 a year. Okay, client's already not paying premium, I'm guessing, and they didn't want to pay the $5,000 a year. So that's going to accumulate year over year over year over year. 10 years in, you're talking about another close to $70,000 with additional compounding interest on that. So now your policy is going to be in a position that it's not going to be a good spot. There's a tax liability. And why is there a tax liability?
Because you got a basis of 175 and you got cash of 375. You got
that's right.
The policy did what it was supposed to do. It made them money.
Yep, it made them money. It did well. It performed great. It was doing great. But this loan, which today may not seem like a big deal, 10 years from now, it's going to be a significant derailer of this policy. And for those of you that have ever seen a policy with a loan lapse, every part of that loan is going to be taxable above cost basis. And typically with a product like this, if it's going to continue to spiral, it's going to be a pretty significant tax hit.
Well, and then on top of that, like they lose their gain to phantom losses. Like they've got $200,000 worth of gain in this contract, but they didn't receive the benefits of that gain because it's accumulating on the loan ledger. It'd be one thing if they
Right.
put it in their pocket. This is just the interest. They
Yep.
didn't even get the benefit from the gain.
Yeah, and that's the heartfelt truth with all of these, right? Is
Mm-hmm.
why am I getting taxed for something I never touched?
Mm-hmm.
Well, that's unfortunately the way the ledger works. And this is a simple one that we did. We just did a 1035. We actually increased their death benefit by 65% to 1.657. And then in year two, we actually use a withdrawal from cost basis internally and just repay the loan from cost basis. The reason we can do that versus whole life contracts, it's just the way that it works, right?
Mm-hmm.
You can't really take withdrawals from a whole life contract.
Mm-hmm.
There's guaranteed cash that has to stay in there. So really, it's just the dynamics of how the product work, and the loan provisions that exist on our contracts are significantly different than a whole life. A whole life I mentioned 6% loan rate. At Prudential for the first 10 years, it's a net 1% loan, and after year 10, it's a 0.05% loan. So it's
A
you
little
could you
different.
could let that loan ride for 30 years and the policy would still be in really good shape because the loan
Right.
rate is so significantly lower.
Right. And you guys have kind of broadened your arsenal on the ways to attack these things too with, traditionally your guys' VUL product looked really good. And I've had the fortune of doing a couple of these in the past. And, Chuck and his team over at Prudential have come back with the VUL product. And now you guys have an IUL. So for the advisors that are out there that don't have their securities license, they've got more, you guys have more options.
Yeah, after we just came out with our new Momentum IUL product in December. Um, we've wanted to get this product out quicker, but it works really well in this space. We wanted it designed as both an accumulation IUL, but also to help out with these types of policies. We know
Mm-hmm.
there's advisors out there that are not securities licensed, but have clients that look just like this.
Mm-hmm.
And unfortunately, we didn't have the greatest solution for them at the time. Now we do. We're back in that fixed space as well as the variable space. And the same holds true, even if it's a survivorship policy with loans. We've got
Nice.
fixed and variable solutions.
Nice. Very nice. And I can tell you that I had a situation, kind of a one-off, but had a situation where Prudential was able to do a loan rescue, went really, really well. It was very similar to, not the same. I wish there were the same numbers that we had on this case study, but similar situation, similar ratios. And what was interesting is the carrier that we were 1035ing the money from would not send the loan documents. They're not required, they're not mandated to do that. But because Prudential's been in this space for a really long time, Prudential has access, or they have a private letter ruling that shows that if it's done in good faith and if we try to mirror that loan as best we can, the IRS said we'll honor those what we'll honor what your best guess is. So
Yep.
it's important to work with a firm like, or with a company like Prudential, where you guys are, what do you say, 20 plus years doing the loan rescues?
Yeah, yeah, this is our
15?
15th year. We did it prior to that, but we put a really concerted effort to get into this space 15
Yeah,
years ago. And we actually just celebrated a milestone last week. We placed a case, and we've now, in 15 years, we've done over $100 million of new target premium, specifically in the loan rescue space in 15
nice.
years.
The
100
only one
million.
that the only one that's upset about that is the Department of Treasury, because you just saved a lot of people a lot of potential taxes.
We're okay with that.
Yeah, exactly. They'll be okay. All right. Well, we do appreciate you coming in today and sharing some with the business valuation and the loan rescue programs, and you brought up a lot of good points along with in light of the Conley and the policy reviews. And again, it's a great reminder that the resources are out there to help advisors be very successful and continue to be a valued resource and partner with their clients. So, Jason, it's time for our giveaway. Unless we have any questions that have popped up in the chat box, but I'd like you to pick a number between 1 and 37.
Well, I got to go with Old Faithful 22.
22. All right, that's one of my favorite numbers. That's my fiance's birthday number, so that's a good one. So, that is also Rob Galloway's favorite number because he's the winner of the Starbucks gift card in the CE giveaway today. So, congratulations, Rob. And again, I'll remind everybody, Jason will be at our BBT event coming up here at the end of April. Keep your eyes open. You can go on our website and register for that event, as well as looking out for your inbox. You'll be seeing weekly invites from us here at E4. So we do appreciate you again taking time to come in and partner with us and share some resources with us, the complimentary resources with the partnership. And next week, we'll be continuing our business valuation series, and we'll be wrapping it up with learning about North American's complementary business valuation platform and how to use their advanced market department and how we can position an advisor for success in their own markets for business and their overall practice. So want to say thank you to you, Jason. Appreciate it. And also appreciate everybody taking some time this morning to learn a little bit more on the brew. So have a good week. Stay warm. And I hope your business heats up. See you next week.